Welcome to Module 4, where we'll be discussing interest rates, risk and reward, and fixed income securities. Let's start with risk and reward. In a theoretical world, the greater the risk, the greater the return. When we translate that into interest rates, the higher the interest rate, the higher the risk is. Or, looking at it in reverse, the higher the risks, the higher the interest rates. And interest rates, if we look at it, are a function of a couple of different things. First, we'll call this money supply, and time, and risk or credit. Now, when we look at the money supply, this is the basic law of supply and demand. That means that there's money available. When we say money available, that means banks have money, investors have money, the Federal Reserve is making money available to people. If there's a lot of money, then it will be a lot of money in the banking system. The rates will be lower because there's more money, supply of money, than there is for loans, which is demand. So think about that for a second. So if everybody's got cash and nobody wants to borrow, the rate comes down because there's no competitive pressure. It's not a shortage. It's a commodity. When there's less money in the banking system, rates will be higher because perhaps the banks will have lent out the money they have, and as a result, there is going to be the ability to charge more. And the same thing, if we look at this, if people have a need for money, that pushes rates up. So if a lot of people are borrowing, that is going to narrow the supply, and that's going to cause rates to go up. If people aren't borrowing, then rates will tend to drop. And that's what we've seen happen over the past few years. There's a ton of money in the banking system, but the demand isn't there. Now, we've all heard that the Fed has done different things. Well, the Fed can have an impact on short-term rates, okay, because that's what they can set long-term rates because they can be a lender. So what happens is when banks need to borrow, they can borrow from the Federal Reserve. So if they set a low enough a rate, that's what the short-term money will be because banks will be able to borrow for the Fed at that. And that's where they set the Fed funds rate, which is the rate that banks trade overnight money for their deposits at the Federal Reserve. So it sets the rate because you wouldn't go any higher because the Fed will lend at that rate. So that keeps them constrained and down. Now, the other things the Fed has done, and they have done this since 2008, they've engaged in what they've called quantitative easing. Okay, and this is where they're attempting to manipulate or manage the longer term rates. The short term rates the Fed can control by setting the Fed funds rate. Longer term, they don't set the rates, but what they can do is they can buy securities. So what they've been doing is quantitative easing, and they've been buying debt securities, and that has kept interest rates low. So we're starting with money supply. Just a quick summary. It's supply and demand. There's a lot of money in the system, the banking system, which includes commercial banks, investment banks, investment funds, pensions, mutual funds, your money market funds, all of that. If there's a lot of money out there, that is going to keep rates down. Rates will only go up when demand for loans go up and some of this money comes out of the banking system into loans. But right now, banks are sitting on plenty of money and they don't have enough opportunities to lend. That's the money supply. Next, time. The longer the time period, the higher the rate, because you're taking a risk by extending credit to someone over a period of time. So if you look at that, the further out I am, there's more risk, and I need to be compensated for that risk. Okay? And the risk is the ability to pay. We'll talk about that. It includes the inflation risk, that what will happen is that inflation rates will make the bond or that instrument worth less in the future. So you charge more interest to make up for that. There's something called a yield curve. And a yield curve, we're going to take a look at that in a second. We're going to take a look at a yield curve. And this is a yield curve as of 12 June 2019. On the y-axis here are the yields, and on the x-axis here is the maturity. So this is a yield curve for U.S. government securities. And there's four numbers shown. The first one here is June of 18. May of 19 is the green. Blue is June of 2019, a week ago, and 12 June is today, the day I'm recording this. So if we look here, we have a normal yield curve. Okay, shorter rates are longer than long term. And if we look at beginning of May, a month ago, we see that the short-term rates are higher than most of these middle rates. Okay, and when you get out to a 30-year, there is some gap, but this gap really isn't that big. So what it started looking like here was that it was flattening out a little bit, but it's in what we call inverted. Short-term rates are higher than long-term rates. So that means that on a 6-month you could earn probably 249. You go out to a 5-year, you're at 225. You go out to a 10-year, you're at about 2.5. So what we've seen as we've moved from May into June and now is the inversion is getting deeper. So this is always a yield curve, and we'll talk more about how things are priced as we move along. Now, just to give you a sense of a different country, here's Germany. And Germany, as you can see, you might say it's pretty normal that short-term rates are lower than long-term rates. But look at this, there's negative interest rates. So what you're having, these are reflecting the individual economies. They're reflecting the underlying relationship between U.S. dollar and the euro. But essentially what's happening is you can move money from Germany into the U.S., which will drive rates down, because remember, it's a volume-driven thing. There's more money looking, and that's what's keeping the rates as high as they are in the U.S. So that's one of the reasons. The others, if we're looking at it, we go back to this, and we see this. Essentially, the market is interpreting that the economy is not going to grow rapidly, and we're going to have a period of low inflation. Otherwise, these prices would be higher because they would believe that there's more risk associated with inflation and excess growth. So we got the gap there. What should you know? Yeah, you should know what a yield curve means and what these three are. Be a good question for the test. So we talked about the yield curve, but I'd like to show you this, and I think I showed it to you before in the macro overview, but this is a chart going back to probably 1979 and running through today. And what it does is it shows the difference between the 10-year Treasury and the 2-year. Okay, that's spread, the difference. Normal yield curve, the 10-year will be higher than the 2-year. So if we look at this graph, we can see that, yes, that many times it's well above. There are a few instances where it is below. Now, why am I showing you this slide? Well, if you look at where these grays are here, every time there's a gray, that's when the company's been in a recession. So a lot of market statisticians, market opinion makers are looking at this and said, wait a minute, every time it's gotten this low, it has preceded a recession. Now, this is, in these times, there were probably other indicators that were going along with it, but right now, this is not necessarily supported by some of the other quantitative and qualitative data that we're seeing. But it's out there, and history does tend to repeat itself. So this is one to be watching, but it is an important chart to be. Welcome to Module 4, where when we look at this link, we started about with talking about money supply. Time interest rates change, but it's also a function of credit. Credit is a measurement of how one has performed in the past, and there's a lot more to credit besides how the individual or a company has handled their debt in the past, but the thing we call credit. And we're going to get into that momentarily. But the better the credit, the lower the rate, and the worse the credit, the higher the rate. So if you have a good credit, the rate's going to be lower because the risk is lower. The worse the credit, the higher the risk, and thus the higher rate. The quality of the credit also determines the availability of funds. Okay? Because there's only money available if you're going to get repaid. So it's not available for everyone. That's an important thing to note, and many treasurers of firms have found that out, is there's money out there, but you may not be able to access it. One of the things when we look at this is historically it's been assumed that U.S. government obligations are risk-free from a repayment perspective. Okay, that the government will always pay you the amount of that bond. So if you have a government bond for $100,000 on maturity, you will get paid that $100,000. There is no risk associated with that. The risk is with inflation. So you may get the $100,000, but if inflation is running very high, your money is going to be worth less. How does it become guaranteed? The government, the Federal Reserve, can simply print more money. And by printing more money, that will ensure that you will get your money. It may not necessarily be worth that. Now you say, why did I just listen to 10 minutes of this about interest rates? Well, why are we looking at this? It's important to see this. It's a precursor to understanding capital structure and leverage from the internal point of view of what the treasurer does and the CFO in determining optimal capital structure. Understand how banks and other lenders work. Then understand things from an investor perspective. What is it that an investor is looking for in bonds, also known as fixed income investing? The other thing is to understand what it means to you as an individual. If you've already taken personal finance with me this summer or have taken it in the past, some of what we're covering might be a little repetitive, but it's a good refresher. So that's why we're looking at it.